Hi, welcome to an fundamentals of accounting lesson. This lesson is basically meant for those who are undertaking class 11 CBSE or ICSE courses, and this can be also useful for those who are coming from science background to commerce background and undertaking various courses such as BBA, MBA, or CA, CS and ICWA courses. Hopefully, I intend to make this very useful for those who are starting the course, who are learners and who has the desire to learn uh, accounting fundamentals very easily. So let's start. Fundamentals of accounting. Accounting is basically, from a layman's point of view, classifying the economic transactions which are of monetary nature and recording these items in a consequential manner that so that latter the transactions can be summarized in a manner which can be understood by investors, by employees, by managers, lenders, bankers, and all other external agencies such as the tax authorities and government departments. So accounting can be defined as the activity of recording, classifying, and then summarizing the economic activities which are known as transactions and events so that a final outcome can be made at the end of the financial year, which is also known as the fiscal year, in the form of financial statements. But one should also remember, as beginners, as learners, you should also remember that accounting only takes into account those transactions or events which can be expressed in terms of monetary events. For example, X is employed by Reliance Industries. If he is paid a salary for the services he is rendering for the company, then it is known as salary. So he is paid a salary because he works for Reliance Industries. So it is an economic event which has monetary consequences. This can be recorded in the books, and thus accounting includes some person working for another and being paid for the service he renders. However, if the service he is rendering, X working for Reliance Industries, he doesn't get a salary from Reliance Industries, or for that matter any other company, then it is not an economic event because it doesn't give a rise to any economic transaction. His services doesn't have any value. So it cannot be put into the books of accounts. So this is clear that non-monetary terms, non-monetary transactions and events cannot be used in accounting. Let's come to why accounting is needed, objectives. There are quite a number of objectives. First of all, if a business is being run, then the business owner, the managers, or the proprietor of that business must know what kind of transactions and events has already taken place. So to know that, because one cannot remember numerous transactions being undertaken by somebody in the business, and there can be a lot of people working for a large or medium-sized business. For example, Wipro Industries or Infosys or Reliance, they employ more than 1 lakh or suppose more than 10,000 people. So there are thousands of transactions which are done on a daily basis. So accounting or primary objective of accounting as a profession is to maintain these economic events and transactions, keep a record. That is the uh, thing called books of accounts. So books of accounts has to be maintained. So first of all, you have to maintain records of the business. Secondly, at the end of the year, fiscal year, or in some countries like uh, Australia, they don't follow the normal fiscal year. Some other countries like United States, they follow the calendar year. You need to find out if the business is making a profit or loss. If the business is doing transactions, numerous transactions, you need to maintain the records so that at the end of the year, you would be able to undertake the process of summarization so that a profit and loss account or income statement can be made at the end of the year. Income statement is prepared to find out whether the business has uh, undertaken all the transactions in that year, the period in which has been undertaken, whether they have made profit or losses. So the second objective is to be able to know whether profit or loss has occurred. The third is you should also be able to prepare a balance sheet that is known as the statement of financial position for a company. At a particular date, suppose say if the fiscal year starts from 1st April 2021 till 31st March 2022, then on that date a balance sheet or statement of financial position has to be prepared. So you need to know whether the statement of financial position is actually depicting a good business undertaking. What are the assets? What are the liabilities? What are the reserves? The profits of previous years, etc. So apart from undertaking the profit and loss account, one has to prepare the accounting professionals being engaged by the firm has to prepare a balance sheet or statement of financial position. The statement of financial position gives us details about the exact position of assets and liabilities of the organization on a particular date. The fourth objective is that the accounting measures undertaken, the summarization and the classification and the recording of economic events. At the end of the year, the accounting profession and the management of the business needs to make the information available to shareholders, to owners, to lenders, to the banker or the bank which has provided them the loan. So accounting has to be maintained in order to disseminate information about transactions being undertaken. Then we should know which kind of information is used by which kind of people, groups. Some of them are creditors and lenders. Creditors are those who has provided goods and services on credit. They need to know whether the business has been accumulating profits and cash to be able to pay. Tax authorities, they need to determine what is the profit so that they can levy a tax at the rates applicable for that year. Shareholders need to know whether the business is making profit and loss and whether the business will be able to pay a dividend at the end of the year. Management and the employees, this is the group which is most interested in this information, and internally, because they are the people who are in charge of the business, they should be able to uh, know whether the business is making progress. Sales are growing, profits are growing, cost is being limited, so that if the cost is limited, then the profit can be maximized. So these are the primary groups which are interested. We will delve into different other kinds of groups, like investors in general, and what they want, which kind of information they would like to know. We will delve into those in details later. Now, as I said in the previous slide, that uh, the accounting is related to keeping the economic events and transactions in detail, and that is known as books of accounts, which is maintained by the uh, accountants or professionals which are used by the business, employed by the business, and the activity which they undertake are known as bookkeeping. So bookkeeping generally involves recording the business transactions which has monetary value. Non-monetary value like honor, not being represented, not being paid, services rendered without any payment cannot be kept in the books, and they are not recorded. Also, other transactions like uh, when the company is selling, when the business is selling to customers, whether that sale is for cash or the sale is on credit. If the sale is on credit, then you need to have debtors. Debtors are those who have bought goods from the company, from the business on credit. So a detailed record of debtors are needed to be maintained. Similarly, lenders, the people, the bank who has lent money to the business needs to be recorded so that they can be paid off in the future. Also, there has to be detailed records of shareholders. Who are the shareholders? How many shares they held for that year? So bookkeeping is generally about recording all kinds of financial and economic transactions and events in that year, financial year or calendar year in some countries. I will go on to explain some of the basic terms here. We will expand the terms in the next video, which will be the video number 2. Let's come to what is a business transaction. A transaction involves an exchange activity which involves giving and taking. In a business, whether it is undertaken by a single proprietor or various shareholders, there can be numerous kinds of transactions, some of which are listed here. Purchase of goods, payment for transportation expenses, payment of wages, payment of salaries, sale of the goods, collection of money from lenders, collection of money from debtors, collection of cash against sale, payment to creditors. So each of these activities which has economic and monetary value are business transactions which are required to be recorded and classified. In this section, I would try to explain the 4 terms which are very basic and which defines the statement of financial positions: assets, liabilities, expenses, and capital. First, the term asset. Asset means properties. They can be properties which are owned by the business. For example, a piece of land, inventory, which is stock, which needs to be sold, investments, plant and machineries, cash, debtors. These are assets which can be defined as properties owned by the business. Assets, according to the conceptual framework developed by IASB, are those resources which a company or enterprise owns and controls, and which are expected to provide economic benefits for the enterprise in the next few years in the future. So assets are expected to be revenue generating in nature. For example, a building where officials generally meet for undertaking business. Plant and machinery is a factory where production will be made. Inventory or stock which can be sold to customers to generate revenue. So let's come to the term liability. Liability is the exact opposite of assets. While assets are owned by the enterprise or the firm, liabilities are those transactions or events which creates future paying liability for the firm. So liabilities are the transactions which are owed by the enterprise to others who are outsiders. For example, a bank giving a loan for undertaking day-to-day activities to a business. Because the bank has given a loan to the company, for example, Reliance Industries, so Reliance Industry will receive cash at the time the loan is given, but it has to repay the same amount along with the agreed interest in the future. So the loan creates a liability, the amount which is owed by the firm to the bank. They have to be paid as per the agreed deadline or timeline which has been agreed with the bank. So while assets are owned by properties owned by the business, liabilities are amounts owed by the firm to the outsiders. Let's come to the next transaction item, expenses. Expenses are economic benefits which flow out of the firm towards other beneficiaries. And these are expenses which generally happens in the day-to-day business. For example, as I said before, Mr. X worked for Reliance Industries Limited. He will not work for free. He will be given a salary which has been agreed. So the salary when paid at the end of the month will become an expense. This is a general expense. The name is not general expense. It's an administrative natured expenses which must be paid to Mr. X so that he provides the service as desired by the firm. Similarly, rent paid for office, electricity bill paid to the state undertakings, purchase of stationery, purchase of other items which are required by the business are known as expenses. However, expenses can be of two types. If expenses arise in the ordinary course of business like salary, wages paid, and electricity bills paid, postages and stationery, they are known as revenue in nature because they generally they don't stay at the end of the period. But some expenses like purchase of a land is not revenue. They are not extinguished. A land once purchased will stay in the books for many years. Land is never extinguished. Plant and machinery once purchased will stay in the books till the life period, 20-30 years, whatever that might be. It will stay in the books. It will stay in the statement of financial position. So these type of expenses which create assets like land, plant and machinery, motor vehicles, fixtures, they are known as capital expenses, long-term assets. And those expenses which are general administrative in nature and they will extinguish once they are paid are known as revenue expenditures. Let's come to the term capital. It's the most vital term of the four: assets, liabilities, expenses, and capital. For example, if I want to start a business of any kind, suppose say I want to be a tutor online teaching you, I must purchase a laptop. The name of my business is XYZ Limited. I want to purchase a laptop, I want to purchase a camera, I want to purchase desk and chairs. These are assets required by the firm to start the business. But how should I purchase them? Where is the money? I will invest. I will buy. So I am the proprietor. I am the single owner. The single owner is a single proprietor. Proprietor is someone who starts the business by investing money. So I am the single shareholder, single owner, and whatever money I have invested buying the assets will be known as, categorized as capital. Capital is the amount which is invested by the owner, proprietor, or a shareholder in case of a large company like Reliance or Wipro or Microsoft or Apple Inc. or any big company like Samsung Incorporated in the business. Capital is the starting amount of money paid by the shareholders or the owner of the business to start a business. You can also put more money, more capital into the business later, but generally capital can be defined as the amount of money invested by a owner or shareholder in the business. So capital creates assets. Without capital, assets cannot be created. Assets are those things which is owned by the business. So if I invest capital, if I pay suppose say 1 lakh rupees to my business for the tutoring business, I can buy a laptop for 70,000. So laptop becomes an asset. Chairs and desks, suppose say 10,000, that becomes an asset. A camera for 20,000 becomes an asset. So all the assets bought by me equals the capital. But it is not always true that all the capital, all the cash that is invested is spent on buying assets. Some of the assets may not be bought, may not be required. So suppose say I invested capital of 1 lakh, but I bought only assets of 80,000, and the balance of cash is remaining with me, which is still an asset, but its cash is not a long-term asset. So these are the four basic terms, and we discussed relatively certain things about what is accounting, how business transactions are identified, and business transactions are generally identified only if they are of monetary nature. If a business transaction is not of monetary nature, then it would not be a business transaction, it would not be recorded by accounting. So voluntary services, not for profit, cannot be made in the form of accounting transactions. We will continue to discuss other basic terms. There are a lot of things which you should know before you go to items, classification, summarization, and recording. So this is it for today. Hope you will understand. You will go through the same again and again, at least twice, and grasp assets, expenses, capital, and liability. We'll meet you soon. Thank you so much. Bye bye.